liquidity is going to peak in the beginning of 2026, which means that you'll have a peak in all these assets somewhere in the middle of 2026, 3 months later, where if you have liquidity peaking in first quarter, then all these assets will peak in the second quarter. On average, in total, it's hard to say in individual things, but that is kind of what I'm expecting, and that's what I'm projecting out. We are extremely confident over the long period of time. Yes, we will have volatility. Yes, we try to manage some of that, and we do try to manage some of that systemic risk. But over the long period of time, we are so excited about the opportunities out there and what we're seeing in this space. I mean, we're super bullish, and we remain very, very excited about the future. So bring it on.
Lavish opens by highlighting the harsh reality facing investors today. This is one of the most difficult and unpredictable market environments in recent memory. Every trading day begins with a wave of uncertainty, driven by fresh headline risks, ranging from geopolitical flare-ups to shifting economic policies. One of the key factors adding to this volatility is former President Donald Trump's renewed push for protectionist policies, particularly around tariffs and international trade. This rhetoric has reintroduced fears of trade wars and supply chain disruptions, shaking investor confidence and leaving markets vulnerable to sharp swings. Combined with broader concerns like inflation, interest rate moves, and global instability, the result is a highly fragile environment where making sound investment decisions is more challenging than ever. Subscribe now, before Bitcoin hits 1 million and you can't afford Wi-Fi.
Well, everybody's trying to figure out what's going on in the market. It's a very difficult market to be investing and trading in. You've got every single morning, and you hear the big portfolio managers say this, that every single morning you've got some sort of headline risk. And a lot of that headline risk has to do with what's going on with tariffs. And so it's hard to really have a conversation about what's happening with interest rates and the economy without the possible effects of what the tariff war that Trump has waged on so many countries that we're kind of in the middle of. And so what's happening here is the market is trying to price in the probability of awfulizing the outcome of that kind of the tariffs that we could be levying on goods and services, or goods that are coming into the country. Again, every single day we walk in and we don't know what's going to hit the tape. Are we gonna have another headline from Trump that is very strong on tariffs? Are we gonna have a kind of a softer stance for them, like this last weekend where we got headlines that China and US have formed a tentative agreement that brought tariffs down dramatically? We just don't know. And so you're seeing that play out in the markets kind of real time here. And we've had a large drawdown in the markets and a large recovery from those recent lows. And so Bitcoin was down 30%, the NASDAQ was down 20%, or S&P was down 20%. And so we've had these big drawdowns, and they've all but recovered that lost ground on these headlines. So how do you trade that? Well, I think, Scott, you have to pull back and look at the big picture, which is, where's the economy going long term? If the tariffs are not going to have a structural long-term effect on our economy, then where are we headed? And a lot of that data that's coming in is looking weaker and softer. Inflation data, job numbers, these are the Fed is now looking at these. But how soft are they? And how willing is the Fed to get ahead of information and start lowering rates again, or starting QE again, rather than wait for the confirmation that we're heading into a recession? Well, the problem is you've got the chairman of the Fed, Chair Powell, coming out and saying things like, well, we're very concerned with the impact of the tariffs. There's a tariff thing again. And so even though they're supposedly data dependent, which is what he's said for years, the Fed has said, Powell has said that they rely on data. They understand that the data may be lagging a little bit, but they rely on data in order to make their decisions. And that will impact bond prices, that'll impact the borrowing costs, that'll impact liquidity. And so the markets are trying to gauge all of that. So what you're hearing me say, and everything I've said in the last few minutes, is basically a long way of saying is the markets are trying to manage and trade around this just period of great uncertainty. And that's what you're seeing. And Bitcoin is definitely caught up right in the middle of it. Risk assets and gold in particular, they really do follow this money supply and the liquidity of the total liquidity of the world. They follow it pretty closely on a lag. So why does that matter today? What are we seeing today? Well, we're seeing a cycle here. Liquidity is it's kind of turned over the last couple of weeks, and it's contracting, but it had a large expansion before this that all these assets are catching up to, and they still haven't caught up to quite yet. And so we're watching this liquidity and seeing where it goes from here. I do know that Michael's thesis, and it seems to have played out when you look at his work over the last number of years, it looks like liquidity expansion and contraction runs in 5 to 6 year cycles. So, and that would mean that on his measure here, he is projecting that liquidity is going to peak in the beginning of 2026, which means that you'll have a peak in all these assets somewhere in the middle of 2026, 3 months later, where if you have liquidity peaking in first quarter, then all these assets will peak in the second quarter. On average, in total, it's hard to say in individual things, but that is kind of what I'm expecting, and that's what I'm projecting out. Of course, this is all things held equal, and without some sort of, again, like a credit event that causes a crash, a drawdown, and a V recovery because the Fed comes in and prints money, or all central banks, depending on how widespread it is. Those are all things that are on my mind, and if that does happen, in my opinion, that will be an opportunity at some point in order, to take advantage of if we do have a drawdown between now and then. But I'm looking for all these signs and signals to see if we're going to have one, and if and when we are in the middle of one, because sometimes it's really hard to get a handle on. All roads lead to Bitcoin. That's right. So, yeah, I'm all I can say is that the Bitcoin Opportunity Fund, we are extremely confident over the long period of time. Yes, we will have volatility. Yes, we try to manage some of that, and we do try to manage some of that systemic risk. But over the long period of time, we are so excited about the opportunities out there and what we're seeing in this space. I mean, we're super bullish, and we remain very, very excited about the future. So.
This is why Bitcoin's behavior during moments of financial stress is so revealing. It's not that Bitcoin is inherently flawed. It's that it trades in a 24/7 global market where institutions are constantly managing liquidity and risk. As one of the few assets always available to sell, Bitcoin often becomes a pressure valve during times of panic. Despite this, Lavish remains firmly bullish. He views the volatility not as a weakness, but as the cost of entry for potentially massive gains. In his view, the turbulent macro environment is actually converging in support of Bitcoin's long-term value proposition. Now let's go back to the interview.
We've seen a slight decoupling of Bitcoin from other risk assets over the last number of weeks. And you've seen gold have a tremendous run here. It has not left Bitcoin behind, but it's had a tremendous run when you look at it versus Bitcoin this year. The reason for that is what we just talked about, all that uncertainty. It has investors fleeing risk assets to go to, the flight of safety assets, which is like a gold. We're not seeing them pour into treasuries the way they would normally in flight to safety, but that does still happen for sure, especially on the short end of the curve. Now, where is Bitcoin and what do I see happening here? Well, remember, Bitcoin, it still has acted mostly as a risk asset for years, and I've called it the tip of the risk spear. So when you see Bitcoin moving, that something's happening with risk assets. Why does that happen? It often happens on the weekend because when you're a hedge fund or an institution and you see uncertainty and you see turmoil and it starts happening on Friday, Saturday, Sunday, and then you see these huge drawdowns in Bitcoin on Sundays. Why does that happen? That happens because you've got these portfolio managers that are sitting there saying, well, I'm going to get margin calls on Monday if we have this drawdown that it appears we're going to have. And because I have a levered book, so I've got to sell something to get ready to get ahead of that. And what can I sell on Sunday? What's trading? Well, Bitcoin's trading. It trades 24/7. So if you have that on your book, that's an obvious first step. Take 10% of it off. Take 20% of it off, or whatever you think you're going to need to start making margin calls the next morning. Because what happens is when you have these drawdowns, like we've seen some steep drawdowns here, some really large intraday moves. And so when you have that, Scott, everything moves in tandem. And it's called everything correlates to one. We haven't had an everything correlates to one really big moment yet this year. There is the concern that will happen at some point if we have some sort of credit issue or, some sort of credit event, meaning something happening with bonds somewhere. But what happens is when you have that drawdown and you have that volatility, the volatility picks up in the market. And the volatility impacts the amount of margin you have to have on your books. So even if the prices of the things that are on your books are not going down, the volatility rising means that your prime broker is likely going to give you a larger haircut on your borrowing. What do I mean by that? If you are borrowing, if you're borrowing 94%, they're requiring you to put 6% of a position down in cash. Well, if volatility picks up, then they may require you to have 10%, 15%, 20%. And we saw this happen in 2020. And, it was really the first time in my career that I saw this happen in real time, where you had blue chip assets like Apple, Microsoft, that were a 5 or 6% haircut that jumped to 25, 30% overnight, where they required you to have more capital, even though they weren't going down as much as that. They required you to have that much more capital in your position to cover that. And so that happens. And institutions and money managers, portfolio managers, they anticipate this now, that could happen again. And so they look for the assets they can sell. So that's why often on weekends you see Bitcoin draw down like that, because it's something you can sell. It's trading 24/7. So
between central bank debt monetization, weakening fiat currencies, and the steady erosion of real yields, Bitcoin's core value proposition, scarce, decentralized, and unmanipulated, is becoming more relevant by the day. The Bitcoin Opportunity Fund, co-managed by Lavish, is specifically built to navigate this environment. It's focused on managing systemic risk while maintaining long exposure to Bitcoin. As Lavish puts it, we are extremely confident over the long term. Bring it on. Still curious? Click on this next video. Your future self might thank you.